In his latest Bloomberg View, columnist Bill Cohan narrows in on the bond market and why it may be on the brink of disaster. Just last week, in fact, investors took shelter in treasuries, reaching levels not seen since September of 2008 when Lehman Brothers collapsed. And Bill, you say this is ironic. And the quote that you say in your column, you say, given the pathetic display in Washington and the country's ongoing fiscal troubles, you continue to say people turned in droves to the perceived security of the U.S. Treasury market, even though it has never looked shakier. So it is kind of ironic, right, that with all this uncertainty, this is where people are finding security and safety.
Well, right. They think that, the Treasury securities have always been secure. The full faith and confidence of the U.S. government behind these securities, of course, drives people's faith in them. But, to your point about the irony is that, here we're on the brink of a payment default on government payments, hundreds and hundreds of billions of worth of payments, if in fact they allow this to happen on August 2nd, and yet people are still moving to the Treasury market and bidding those prices up in droves, which, could be part of what's defaulted on. So it really defies logic, but I think it just goes to show you the extreme thinking going on in the bond market and how nervous people are about what's going on in Washington.
Hey, that's such a good point. And is it just a case with all the uncertainty around the globe that this is kind of a less risky place to park? Certainly not a big endorsement, but that's the thinking.
And one thing I point out in the column is that the Saudis have decided to pull money out of the U.S. Treasury market and are investing in the euro. They're hedging their bet against the U.S. Treasury. Now, they're pretty sophisticated.
Right.
We owe them a lot of money. And, for them to have a bet on the euro instead of the treasuries is sort of interesting.
You also write about the threat of the downgrades, and I kind of have a yin and yang with the rating agencies because we were so critical of them during the financial crisis, and all of a sudden they're talking about downgrading U.S. debt, and we're paying so much attention. Should we not, or what do you? Well,
Carol, really, I still can be critical of the rating agencies. You can't, and my view is you can't quite be critical enough of the rating agencies based on the way they performed during the financial crisis. But why did it take them this long, till middle of July of 2011, to downgrade or to threat? They haven't even downgraded. They've just had the threat of downgrade on the U.S. government securities, and it's been long overdue.
I want to go back to what you're thinking about treasuries, because I talked with Jim Grant yesterday. He is editor and founder of Grant's Interest Rate Observer, and he really very smart, and he mirrors your thinking about treasuries. Listen up, everybody.
The Treasury market, to me, is working on muscle memory. It has been going up in price, down in yield since 1981, 30 years of a bull market. And people have come to view, I think, again, my opinion, have come to view treasuries as intrinsically safe when, in fact, treasuries are pieces of paper emitted by a government that is cash flow negative.
So, can't argue with that.
Absolutely right. Absolutely right.
So what does the bond market tell us? And I know you quote a lot in your article Gifford Combs, and you talk about them. What then should we read from the bond market, or should we totally disregard it?
Well, look, the bond market, I think they used to say about the stock market that it climbs a wall of worry. The bond market is filled with people who are short-term worriers. Mm-hmm. And in the short term, people are painfully scared that the U.S. politicians, most likely the Republicans, if they continue to stymie this process, are going to make it possible for the U.S. to default on their debt obligations. Now, I don't really think that's going to happen, but the bond market last week was acting as if it were going to happen. Today, things seem a little better because we had Obama come out today saying there's this plan that they're willing to endorse potentially. Geithner has said maybe it's all just a bit of a charade and politicking. So, we'll see.
And, what I also thought was interesting is you talk about the New York Fed and how they've been watching very, very, very closely the money markets. And we were talking about that a few weeks ago, and it seems to have died down. But they are worried also about those money markets. There's a big open secret on Wall Street now that the New York Fed is urging money market funds to get out of euro-dollar exposure because they believe there are provisions in the Dodd-Frank law that make it more difficult for them to save a money market fund, as they did with the reserve fund after Lehman Brothers failed. Now, they don't feel like they can do that. So they're urging these funds to get out of euro-dollar exposure because they feel like that's riskier. And, of course, it is on a relative basis, compared to treasuries, unless treasuries default. So, we have a world of risk out there, and the Fed is, right to be worried about it. Yeah. And, maybe they should be more public about their worry, frankly, and get people to act instead of,
just worry.
We can only hope, right?
We can only hope before it's too late.
Yeah, let's hope so, though. Bill, thank you so much. Bill Cohan joining us with his Bloomberg View column this afternoon. You can read Bill's complete view plus many others on Bloomberg.com/HView.